Once again, we see that the price has taken the low of the previous candle, effectively sweeping liquidity below it with this bearish inverted hammer candle. Thus, we have a potential candidate for a valid order block. However, there is no noticeable imbalance among these three candles, and the order block is mitigated by the upper wick of the bullish candle. Consequently, this order block cannot be considered valid, as it fails to meet most of the necessary criteria for validating an order block. Therefore, it cannot be utilized as a demand zone. When faced with scenarios like this, where the price has taken out the liquidity from the previous candle, but the order block is mitigated, or when the price fails to create inefficiency, we designate the subsequent candlestick as the valid order block. In this case, we identify this bullish candle as the valid order block instead of the previous selling candle. This decision is based on the fact that the price has generated a proper inefficiency or imbalance immediately following the bullish candle. If we look slightly higher, we notice that the price has taken the low of the previous candle, effectively sweeping liquidity below it with this bullish candle, before the price starts to push significantly higher. However, there is no discernible imbalance, and this order block is mitigated by the upper candle's wick. Therefore, this order block cannot be regarded as valid and consequently cannot be utilized as a demand area. Continuing, once again we see that the price has pushed significantly to the upside. This red candle represents the latest bearish candle that has just formed before the price started to push dramatically higher. It is evident that this bearish candle has surpassed and effectively swept the liquidity below the previous bullish candle. As the price has also created a proper gap between these three sequential candles, and there is no mitigation, all the criteria for identifying a valid order block have been met. Consequently, we can now regard this candle as a valid order block. These concepts are applicable to bearish markets as well. It's important to note that these principles can be applied across various time frames and any price action-based chart. Now let's proceed to the real chart and integrate all the concepts we've explored in this video. We'll examine how to effectively identify valid order blocks in the market. So here we have Euro-Dollar 15-minute time frame chart on the screen. As you can see, the market's overall direction is in an uptrend. Upon analyzing the chart, we notice that the price has established a bullish break of structure by breaking and closing above this major high. With the emergence of the break of structure, our focus should now shift to identifying order blocks associated with the BOS. This white candle at the extreme represents the last bearish candle that has recently formed before the price began a significant upward push. It has successfully taken out and swept the liquidity below the previous candle. However, upon closer look, if we highlight this candle, it becomes apparent that this order block is mitigated by the upper tiny wick. Therefore, we cannot consider it a valid order block. Looking slightly higher, we notice another bearish candle that represents the last one before the price began a significant upward push. It's clear that this candle has taken out the low of the previous candle. Upon highlighting it, we see that it is mitigated by the upper wick of the bullish candle. As mentioned earlier, if our identified order block is mitigated by the last candle of the three sequence candles, we should consider the next candlestick as the valid order block. Therefore, this candle serves as our valid order block. Let's continue. In the following sequence, we see that the price has initiated another upward movement, and this candle is the last bearish one before the upward push. It has taken out the low of the previous candle. However, upon highlighting it, we see mitigation with the wick of the third candle, mirroring a scenario we discussed earlier. Consequently, we identify the next candlestick as the order block. Yet again, it is mitigated, this time by the upper candle's wick. Therefore, we proceed to the next candlestick. Traders, the red hammer that follows is our valid order block. Nevertheless, upon closer look, we note that the price touched it, and after a minor reaction, pushed to the downside without respecting the order block. The primary reason for such price action is that we should always wait for the price to take out the inducement before executing a buy or sell position. This topic has been covered in our earlier episodes. I highly recommend that you go through our channel and watch them for a more comprehensive understanding. Continuing, we see that the price continued its downward momentum, pulled into our valid order block, experienced a reversal, and subsequently pushed higher. If we were analyzing a live chart, this order block would present a great opportunity for us to execute a long position and enter the market. In the continue, we see that the price has formed a change of character pattern by breaking and closing this structure. After the emergence of the change of character, it is crucial to wait for the price to take out the inducement before considering long or short trades and entering the market. In this case, this candle's low represents the most recent internal level that the price has formed in its upward path. So, once the market has taken out the inducement, the next step is to wait for the price to mitigate our identified valid order block. In this scenario, this white candle represents the last bearish candle that formed just before the price pushed drastically to the upside, sweeping the liquidity below the previous candle's low. Additionally, there is a noticeable imbalance above it. Hence, this candle is our valid order block, offering a high probability if the price mitigates it. If the price taps into it, we should consider entering the market with a long position. But before we continue, it's important to note a crucial step in your trading journey: backtesting your strategies.